Let's start with what many of us are familiar with: traditional investments, stocks, bonds, real estate. These have been the go-to options for generations of investors. But here's the kicker: they're all inversely correlated to rising interest rates. In simple terms, when rates go up, these investments tend to struggle. Right now, we're in a period of rate hikes, and it's making life difficult for investors across the board. The stock market's volatility, the bond market's decline, and the cooling real estate market are all symptoms of this larger trend. In times like these, the old adage of return on capital is being replaced by a more cautious return of capital. What does this mean? Well, instead of chasing high returns, smart investors are focusing on preserving their purchasing power and ensuring they don't lose what they already have. It's a defensive strategy, sure, but in a financial landscape as uncertain as ours, it's becoming increasingly necessary. Remember, in investments, sometimes the best offense is a good defense, and right now that defense is looking more like a fortress than a simple hedge. Now let's talk about a trend that's raising eyebrows in financial circles: significant metal withdrawals. We're seeing major investors pulling out large amounts of gold and silver from established exchanges like the London Metals Exchange, LME, and COMEX. But why is this happening? Well, it's not because these investors suddenly developed a passion for shiny objects. No, this movement signals something much more significant: a growing concern about the future of our financial system. These aren't small-time players we're talking about. These are wealthy, well-informed investors who are increasingly moving towards commodities like gold and silver. But here's the kicker: they're not just buying paper contracts or ETFs. They're taking physical possession of these metals. By doing this, they're eliminating what's known as counterparty risk. In other words, they're ensuring that their wealth isn't dependent on the promises or performance of any other entity. It's a move towards true ownership and control of assets. This shift is particularly noteworthy because it's happening at a time when traditional safe haven assets like government bonds are looking less attractive due to low or negative real yields. Gold and silver, with their long history as stores of value, are becoming the new safe deposit boxes for the wealthy. But it's not just individual investors making this move. We're seeing a new group emerge on the COMEX, cryptically referred to as others. These are likely sovereign wealth funds and family offices, and they're actively accumulating precious metals in kilobars. It's a clear sign that they're hedging against future uncertainty on a massive scale. Let's put some numbers to this trend because they're truly staggering. Recently, we've seen a withdrawal of 175 million ounces of gold from COMEX. Let that sink in for a moment. That's not just a trickle, it's a flood. To give you some perspective, this is an unprecedented movement of physical gold. It's not just large, it's historically large. This kind of withdrawal doesn't happen without good reason. It points to an expectation of upcoming financial turmoil by major investors. These aren't people making decisions based on hunches or headlines. These are sophisticated players with access to high-level information and analysis. When they move in such large numbers, it's worth paying attention. But it's not just about the amount of gold being withdrawn. It's about what this movement represents. It's a vote of no confidence in the current financial system. It's a hedge against uncertainty. And most importantly, it's a preparation for a future that these investors see as potentially turbulent. Remember, in the world of high finance, actions speak louder than words, and right now these actions are screaming that something big is on the horizon. The demand for precious metals isn't just coming from Western investors. We're seeing a significant uptick in demand from non-Western countries as well. But it's not just about buying gold and silver, it's about changing how these metals are priced and traded. There's a growing push for a new price-setting hub, potentially in Moscow, to reduce the influence of Western financial systems on precious metal prices. This isn't just about economics, it's about geopolitics and the balance of global financial power. Countries are increasingly looking to de-dollarize their economies and reduce their dependence on Western-controlled financial mechanisms. Gold and silver, with their universal value and lack of counterparty risk, are becoming key players in this shift. This global demand is putting pressure on the existing systems and could lead to a fundamental reshaping of how we value and trade precious metals. It's a trend that could have far-reaching implications, not just for investors, but for the global financial order as a whole. As investors, it's crucial to understand these global dynamics. They're not just abstract geopolitical moves. They have real, tangible effects on asset values and investment strategies. Now, let's talk about the elephant in the room: inflation. It's a word we've been hearing a lot lately, but here's the thing: the official inflation rates you're hearing about, they're likely understated, significantly understated. If we look at historical comparisons and use consistent measurement methods, we'd likely see inflation rates that are much higher than what's being reported. And this isn't a new problem. It's been an issue for a long, long time. We're talking since Roman times. But why does this matter? Well, inflation isn't just a number, it's a silent tax on your wealth. It erodes your purchasing power, making your money worth less over time. And if the real inflation rate is higher than what's being reported, it means your wealth is eroding faster than you think. This is where the Federal Reserve comes in. Traditionally, the Fed's job is to combat inflation by raising interest rates. But here's the problem: they're in a tough spot. Raising rates aggressively enough to truly combat inflation would likely lead to severe consequences in markets like stocks, bonds, and real estate. So we're left with a difficult choice. On one hand, we could see the Fed refuse or be unable to raise rates aggressively, which could potentially lead to hyperinflation. On the other hand, if they do raise rates significantly, we could see severe economic upheaval. It's a classic case of being stuck between a rock and a hard place. And it's one of the main reasons why we're seeing this shift towards precious metals. In times of high inflation, gold and silver have historically served as effective hedges. So where does all this leave us? We're in a period of significant economic uncertainty. Traditional investments are facing challenges. Major players are moving towards precious metals, and inflation looms large on the horizon. As investors and individuals concerned about preserving our wealth, it's crucial to stay informed and consider diversifying our strategies. The moves we're seeing from major investors and institutions can provide valuable insights into potential future trends. Remember, the goal isn't to predict the future with certainty. That's impossible. Instead, it's about understanding the trends, assessing the risks, and positioning ourselves to weather whatever economic storms may come our way. Whether that means considering an allocation to precious metals, reevaluating our traditional investment strategies, or simply staying more informed about global economic trends, the key is to be proactive rather than reactive. We're living in interesting economic times, and while that can be scary, it also presents opportunities for those who are prepared. Stay informed, stay diversified, and most importantly, stay engaged with your financial future. Thank you for watching, and until next time, take care and invest wisely.